Varun Saboo as well joins in on the show to talk about what he's making of the market right now. Varun, hi afternoon. Quite consolidation, and I guess it was high time as well that you had days like yesterday or even today, perhaps, for the market, which has really been just one way ride up.
Yeah, hi. Thanks, now again for inviting us on the show. So obviously markets have been on a tear, right? And that continues. So nothing has changed. It's just one day of correction, and then it again resolves the same thing and the run starts again. This has been happening multiple times. You can go and check for last several months that we see one day of sharp correction, and in the next few days or say a week or two, markets reclaim the new high. So I don't think so the trend is going to change soon. Why I don't see that is because fundamentally things are absolutely in place. We are not seeing any change in terms of any corporate commentary that we are in touch with. We are not seeing any change in the channel checks which we are doing. So things don't change at all versus what I was speaking to you multiple times in the last several months that I've come on the show, right? One thing is there that we need to also recognize that most brokerages now will start shifting to FY27 numbers in a month or two. Again, with that, there will be a 15% plus upside in earnings that we will see. So Nifty, which is currently at 19 and a half times FY26 earnings, somewhere around that, most brokerage houses are, will look even again 15% cheaper. So, there will be again more legs for Nifty to move up. Obviously, stocks underlying will move up faster and more. So I still am very hopeful and very positive on the markets, and I still think that Nifty can easily trade upwards of 25 times, even if I have to give a 2.5 times peg to the country's GDP growth. So that's how I'm seeing it. So still see material upsides from current levels.
The sectors that you would put fresh money to work?
You need to find pockets where there is value and strength as well. So strength is there across, but where there is value, I clearly see a case where banks should start re-rating. It's been a while that banking pack has been under pressure. I was extremely positive on IT when I had come last time. In fact, last couple of times, I think IT will start going through a phase of consolidation, although it's the best time for IT companies when a rate cut cycle starts. But the run has been very, very sharp in the last one and a half months that we see. I think banks will start catching up. They have been under pressure for a while. Particularly in that also, I would be very positive on PSU banks. So PSU banks is where there is a lot of value, and I don't see anything changing in terms of any negative coming there. I don't see the rate in terms of the asset quality cycle going bad. In my view, in this current scenario, they are going to be one of the key beneficiaries with the rate cut cycle also starting. And yeah, I think numbers per se, etc. I don't see anything coming as such worrisome. So valuations are extremely attractive. You're getting them all at book or sub book, so which is very cheap. So I'll be very positive on that. In autos, I will have my pockets of strength, which I'll still go with. Two wheelers is something which we have been recommending. In that, a new name comes up for me. I think I'm going to be very, very positive on Eicher Motors. We can discuss that in details later. But Eicher is my big top bet, and I think that's going to have very, very strong legs going forward. In terms of tractors, so in terms of tractors as a pack in the auto space, we are very positive on. I think Escorts and M&M both can do very well from here. So yeah, there are pockets of strength which we are seeing. We'll go with that, and we'll figure out value also in spaces which have already run up, but we'll try to figure out value in spaces which have also run. So in terms of construction infra, I see PSP project as a name, which is very interesting. So there are many names. There are a lot of ideas which are still having a lot of value to go ahead with.
Enough, a whole host of stocks that you're flagging off. Meantime, what's the view then when it comes to the defensive tilt? Is there anything that you like within FMCG and pharma?
Yeah, so both of these sectors have also done quite well in the last 3 to 6 months. See, things are turning around when it comes to rural India, right? We are hearing quite a lot of positive commentary that whenever we are doing channel checks around rural India. There's a lot of hope getting built in terms of how FMCG pickup could happen, and that's what has led to the rally here. I don't see material upsides for the FMCG names from here, honestly. This is not a time to be in defensive. There's a time to still be in beta names, and I would continue with the same thesis. And not that they're cheap, so it's not that the valuations are giving you that comfort there. So if I have to buy something expensive, I might as well buy a growth stock rather than buying a defensive right now. So that view will continue. That we would not prefer defensive right now. Pharma is a very separate case. There are some stocks in pharma which are looking very good. There are certain themes in pharma which are looking very good. So with the Biosecure Act being there, I think CDMO companies will benefit. In that, a unique place there, which is Syngene. That could be an interesting one to look at for anyone. They are the only ones, probably one of the very few names who have taken a jump in the biologics. So we would be kind of comfortable in the CDMO space if something has to be looked at. So a name like Zydus is interesting to look at, which has gone through its own correction. There was a drug approval which came. And in terms of downside, I hardly see any downside there. There's been too much concerns being based on Asacol HD. I think that's also done with. Things should start looking up for them as well. So pharma also, there are pockets of strength which one can look at. And yeah, obviously, if you have to see the entire healthcare pack, hospitals is something which we are very positive on. Most of the hospitals that we look at, top being Apollo Hospital that we really like from here. So that's one name. Medanta is something which we like. We like Rainbow Hospital. So there are multiple names in the hospital space also. So yeah, all in all, you have to go bottom up now more than looking at top down for the time being.
So let's pick up some of those ideas then, Varun. And I'm going to start out with Eicher. What is it that you like in that story? Is it the farm revival or is it RE that you're continuing to bet on?
So it's a great mix of both. So what is exciting me in the name is whenever I go on the ground or I meet any company. So either I go and meet in tier 2, tier 3 villages when I'm meeting people, dealers, channels, etc., or I'm going and meeting corporates. One thing which is coming and which is coming out as a very big story is the aspirational buying, the premiumization story which is going on, and that's continuing and that's gaining legs further, right? I see a big change there. I think people will keep moving higher. 125cc biker will keep moving to 150 plus cc. A 150cc biker will move higher, right? I see the cruiser segment to pick up because there is where the machoism, and that's what is exciting people on the ground. And RE is the best brand when it comes to that. And brand holds a lot of value. We have seen that in the four-wheelers playing over, right? We saw SUVs as a category when in the earlier days, Scorpio and Bolero, etc., had come, where it was a very niche segment. And today, it's the segment in the four-wheeler space. I see that happening in the two-wheeler space. It will take time. People will believe this once it happens, but I'm calling it early, and I think the category will expand big time. And there is where RE holds a huge advantage. I am extremely positive on Eicher from that perspective. And the good part is that it has gone through consolidation. It is now at par in terms of, or a little cheaper in terms of valuations when it comes to TVS or a Bajaj Auto. Not that I'm negative on those companies, I'm very positive on them as well, but I think Eicher is a multi-year story which is beginning from here.
Do you have that kind of conviction looking at the charts of Eicher too?
See, short-term trading activity could be seen into the stock price, but there's nothing major which has happened in terms of the outperformance. So what's happened is that Bajaj Auto was one of the best performers in the two-wheeler pack. Hero MotoCorp had its fair share of price uptrend towards 6,100, 200 mark, but that stock has also slipped and it's now sub the 6,000 levels quite decisively. But then on the other hand, there was the period where Bajaj Auto outperformed, Hero MotoCorp managed to outclass or shine up quite well. Eicher Motors has remained into a range. So, we can call it as a relative strength that on the way down, when stocks like Hero MotoCorp or Bajaj Auto, if these stocks are correcting, then Eicher Motors is showing signs of a relative strength so far. But when you look at this as a larger picture over the last 9 to 10 months, there's nothing major which has happened to the stock price where we could probably call it into a breakout. So I think we'll have to wait out for in terms of technical patterns for Eicher Motors to break past about the series of resistances. 5200, 5250 is the first and the most crucial resistance for Eicher Motors. I think only a break above those levels is where I would look to buy.
Okay, fair enough. Meantime, Naresh, what is it that you're looking at when it comes to capital goods, the likes of ABB India, Siemens? They're all active in trade today. Any other stocks within this space, or what are you tracking?
So ABB Siemens have had a very strong run, but they continue to consolidate higher. So Siemens, after a dip from 8,000 to 6,500, has slowly scaled up back to closer to 73, 7,500. So I would not expect them to cross the recent highs. So would expect consolidations and selling pressure at higher levels. The only one which still looks interesting is L&T, which has gone through a 6 to 8 month phase of consolidation. 3,500 on the downside, 3,800 on the upside. If it sustains 3,800, 3,850, that would be a fresh breakout to look out for. So in terms of cap good names, L&T seems the best at current levels.
Okay, that's the view coming in. L&T continues to remain the favorite. Varun, would you concur when it comes to the fundamentals as well?
Absolutely. I don't see any doubt that in infra, that's the best name, the bellwether name that we have. And in terms of the hope that is there, that the private capex cycle will also pick up, I see L&T to be a key beneficiary there as well.
Coming in on L&T, let's just address some of the other movers. You've got a Star Cement. That's also one stock which is in focus. One of their subsidiaries has been declared as the preferred bidder for limestone blocks in Rajasthan. And the blocks are estimated resource of about almost 64 million tons. So look out for that stock. There's Century Textiles as well, wherein Birla Estates Ramaya Phase 2, the park, has sold almost about 95% of its inventory within 24 hours of its launch, and they've achieved a booking of about 600 odd crore rupees. Varun, your thoughts on how the pure play realty plays, the ancillaries, and how some of these companies which are also sort of unlocking real estate, which is sitting in the company, are going to be beneficiaries in this current bull run?
See, if you're talking about real estate as a pack overall to begin with, I'm extremely excited about this opportunity. We keep talking about equities being in the best bull run ever, the mother of all bull runs, etc., which we keep talking about. Simultaneously, this entire real estate, the entire reality space has also entered into a very, very strong and sharp bull run. Why I'm saying so is because there's a clear shift which is happening from individual residential buildings to these large complexes, etc., which these builders are coming up with. And there's very little inventory of it. So inventory is extremely low. Pricing will keep moving higher in this space, and that's going to take a lot of years for this to get corrected. And that's where the strength lies. I think real estate is going to remain in a very, very strong flavor. So that's not going to change anytime soon. Others who are encashing on their reality is to obviously liquidate and make use of the current situation where the best time to sell anything is when money is available and when money is chasing assets. So there's a time when people are encashing and focusing on their core businesses. So which is also not a bad ploy because everything is doing well. So that's something which is separately happening and that will keep happening, which we'll see. But yeah, I think as a real estate space, I'll still remain very, very bullish over a period of time.
Some of these market-related or brokerage stocks as well are buzzing. Angel One being one such case in point. They've actually upped the rates, the charges, which are going to be now levied at flat 20 or 0.1% plus GST, whichever is lower as per the executed order. And the charges come into effect from the 1st of November. This is also going to sort of offset the revenue loss because of the new fee structure by the regulator, which would have impacted revenues by about 7 to 8%. Varun, in the entire capital markets theme, and very few listed options there, anything that you particularly like or are tracking?
In the current scenario, I like to avoid talking about the capital markets stocks. I mean, it's more of a competition to me. So I'll refrain from talking, and not that we have any coverage there. So I'll try to refrain from them.
Fair enough. But in the meantime, also wanted to draw attention to some of the other consumption stocks that are in the spotlight. You've got Havells, JP Morgan has maintained neutral here, saying that the B2B demand is looking quite healthy and they're seeing mid-teen non-Lloyd operating margins kicking in. So all eyes will also be on the upcoming festive season. GCPL, JP Morgan is overweight, but says that margins could come under a bit of pressure and that there is some strong demand for their newly launched incense sticks that could be boding well. Dabur as well on their radar. They believe that a positive rural uptake, that's JP Morgan who believes, is going to be a key catalyst, while monsoon seems to be weighing on the revenue growth in the beverages segment. And there's Crompton Consumer as well, that they target doubling their revenue over the next 5 years. So watch out for some of those candidates as well. Meantime, let's get in those BTST trades from our chartists. And Naresh, take us through your call.
So first is a buy on Dr. Lalpath Labs. The stock is giving a flag breakout now. Good trend there. Stop loss at 33.70, target price of 34.50. Second is a buy on UPL, trying to cross the recent swing high. Stop loss at 618, target price of 632.
Okay, there you have it. It's UPL. Meantime, Kunal, what is it that you're picking out as your BTST trade?
So I'll go with the buy on Syngene. That's a chart which is looking attractive at 910 levels where it's trading right now. So would look out for targets in the range of 945. Stop loss to be kept at 888. And Tech Mahindra is something which has started to look attractive in terms of a contra play. Expect the stock to break past about the previous swing highs, which is around the 1660 mark. Stop loss for this trade 1590.
Varun, what's your thought on IT? Do you know, while the entire sector has chugged along nicely and Nifty IT is sitting on a life high for itself. Other than that, of course, I guess the US interest rate scenario is sentiment positive. But do you think in the long haul, it's the niche players like a persistent KPIT which will continue to win the race?
See, IT has gone through a sharp uptick, right, in the last couple of months. What has happened is that valuations have rallied ahead of what changes could have happened. So if you see, most stocks are upwards of 30 times, 35 times in terms of when it comes to the mid-cap IT companies. Even the larger caps like Infi, TCS, etc. are somewhere around 27, 28 times now. But yeah, in a rate cut cycle, these are big beneficiaries, and definitely things as sentiments will keep changing. What US has done right this time is that they have been proactive in terms of saving the economy from entering into a recession, and that should help going forward. So things would remain firm in IT pack, but I don't see a sharp rally in the IT index as such. What I think is that you have to pick up the right stocks within them. I would probably prefer in this scenario where a rate cut cycle has started to be in the leverage place. So something like emphasis there could be a very interesting name, which has a high quotient of mortgage led revenues coming for them. So that could be an interesting place still from here. Something like a Tech Mahindra or a FSL, which has a higher component of telecom, and these are also leverage plays, right? Telecom is a leverage play, so that should also benefit going forward. Something like a LTIM, which has a high BFSI quotient. So I would pick and choose the right stocks in the space, and yeah, I think things seem to be fine. The sector might consolidate for some time, but I don't rule out upsides in some stocks over here.
If you like this video, then like, share and subscribe to ET Now.